Hello and welcome to this introduction video for cryptocurrencies. I'm going to be making a number of different videos about different cryptocurrencies, and here I'd like to explain to you a little bit about what I'm going to talk about and why I'm going to talk about it. First of all, this is going to be about what cryptocurrencies are and how they work. I picked these three cryptocurrencies that I'm going to be focusing on, although I don't rule out adding other cryptocurrencies in the future that are interesting. So, why do I pick these currencies to talk about? Well, Bitcoin is the first cryptocurrency that got introduced. It came in 2009 based on a white paper written by a mysterious hacker named Satoshi, which we don't really know the identity of yet. And it's grown to a big phenomenon. So most of the cryptocurrencies that we see today has been influenced or derived from Bitcoin. Now there are hundreds, if not thousands, of different cryptocurrencies. I'm not going to talk about all of them naturally, and you don't have to, because a lot of them are really just variations of the Bitcoin technology. They don't really offer very much new. They're just kind of Me Too products. One example is Bitcoin Cash, which is just a minor difference. Likewise, Litecoin is just Bitcoin with a slightly different algorithm. Possibly it's changed a little bit since the beginning now. But I don't think you really need to create a different video explaining Litecoin. As for Ripple, I think it's a very interesting to talk about because it came quite early, but it was a completely different approach to cryptocurrencies from Bitcoin. And it's not really just one currency. It's a whole system for making money payments. And Ethereum is interesting because it's the first one that really took the step further of creating a kind of an ecosystem where you could build different kinds of applications on top of the cryptocurrency system. So it's not just a currency, but also a way where you can create what we call smart contracts and dApps that allow you to trade in different kinds of assets or do a lot of other different things. All of these systems are distributed. It's not a central server involved. So in this regard, this is bringing the kind of approach to money as we've seen with Napster earlier in music sharing. This means that there's no central server taking care of Bitcoin and Ripple transactions. It's a peer-to-peer system. The way this works is that there is a distributed ledger. A ledger is what we in finance call the book, where we keep all transactions. Typically, we have transactions for different accounts with the debit and credit columns, meaning money coming into an account and money going out of an account. So the exact meaning of the ledger will vary with each system, and it will also vary how the different servers are going to be connected. So you might ask, well, isn't this just the same as digital currency? It's just electronic money. We already have that with PayPal, Google, Apple Pay. Well, even banks today offer money transactions electronically. So what's new with cryptocurrencies? Well, the central thing, which is in the name, is that exchange is facilitated by cryptography. With PayPal or Google Wallet, we really depend on trusting a third party such as PayPal or Google that they're going to update our balance in the correct way. With cryptocurrencies, there is no central player, there's no third party that you're trusting. And so when you're making transactions, there's nobody that you can trust making the right thing. So we're entirely dependent on using cryptography to sign off on transactions so that they can be verified that they're true later. Now, of course, banks and others might use cryptography to secure the communication channels between its users and the server. However, cryptography is not something that's used centrally. It's not something they have to use to sign off when they're making transactions. Whereas this is it's a core concept for cryptocurrencies. Another important aspect is that almost all cryptocurrencies, I think there are some exceptions, but in general, they have a limited supply of money. Money enters the system gradually, or it could be all have been created initially, but from there on it doesn't really expand. Whereas most digital money is based on some kind of fiat currency, which could in principle be created in limitless supply. And as mentioned, of course, it's a decentralized system. There's no central database controlled by, say, Google or Apple that keeps track of how much money each one has, or a bank that has, all your statements, how much money you have in each account. An interesting implication of this is, and I notice that whenever I talk to people about cryptocurrencies and they want to get into it, is that they wonder, well, where's the place that I sign up to get an account? That's what people are used to with bank accounts. Well, there is no central place where you sign up to get a bank account. In theory, you could just run a program locally on your computer and create, basically, you might call it an account, but we call it usually a wallet, that you can use to send and receive money. So you're just dependent on the software, you're not dependent on the service. Of course, people do use various services to give the means to exchange regular money or fiat money for cryptocurrencies. So what's the benefits of such a system? Well, one problem today is that bank transactions have to go through a myriad of different networks that all take a cut. For instance, the SWIFT system, widely used today, dates from the 70s and is quite old and batch-oriented, which makes it slow. And it also relies on going through multiple banks and central banks to make a payment. And this time it creates a counterbalance risk that causes it to cost more money. So you can see this with various centralized systems such as Western Union that charges $15 to $50 for a transaction. This might have come down since I created these slides. Same goes for if you're doing international money transfer, that could cost 10 to 15%. I suspect that these numbers have been going down because for the last years, there have come a number of companies that are offering money transfer service using cryptocurrencies in the background. So you as a customer don't really know that that's what they're doing, but this is something they can utilize to cut the costs. And also, it takes away another way that people lose money, which is that the banks use unfavorable exchange rates. So basically the way that these money transfer services work that utilize cryptocurrencies is that you send money to them with a local bank account, and then they buy cryptocurrencies on an exchange, and then in one country, and then they sell it in another and transfer it to your bank account. Important for many people is customer anonymity. You don't have much anonymity with credit card transactions and bank transactions and so on. And often people want to have the same kind of anonymity online as they have when using cash. Unfortunately, cash requires that you meet in person, but you like to be able to do that online as well. Now, this is an area I don't really know that much about, but from what I know, when you're making a transaction using credit cards, the payment is not really final. The customer could call a Visa or MasterCard and say that it's a fault or a flaw there. You shouldn't be transferring this money, and so you can cancel the payment to the merchant, and the merchant might already have sent you the product, and so they don't get their payment. With cryptocurrencies, the transactions and the payments are final. So when you got the money, that you know that you have it. And depending on where you live in the world, this could be a benefit or a downside, that it's not controlled by a single government. For those of us that live in free democracies, it might not seem like a benefit with a system that could avoid the rules set by a government or subvert the government's plans. However, a lot of people do live in unfree societies where government could have draconian rules in how they send or use their money. They might have policies that create a huge amount of inflation. So people lose their money, but they're unable to exchange it for other money to protect their savings. And we've seen cryptocurrency gain a lot of interest in countries where you have seen massive amounts of inflation coupled with currency controls. Now, before we start talking about cryptocurrencies, and whenever you see this in the news, you'll probably encounter a lot of different terminology: digital signatures, private keys, nouns, blocks, blockchain, transactions, and so on. And so there's a lot of terminology that's unfamiliar. And for that reason, the first video I want you to have a look at in this series is going to cover the basics of cryptography. And I'm going to focus on the part of cryptography that is used with cryptocurrencies. I made this video so that it doesn't rely on math equations or anything like that. I'm using it as approachable to people as possible who's interested in cryptocurrencies, but not necessarily mathematics.